Daddy Cilinix is here. What's up, everybody? Hope you're all doing great. If it looks like I'm crying, then that's because of the interest rates. No, I just did some. No. Kanoi, you're too late. You're too late. I'm here. I'm here now. But I just did some eye drops, so my eyes are still a little bit watery, but should be fine. And we're going to have an amazing stream again. We'll take a look at the interest rate. Obviously, it stayed the same, but that was to be expected. It's still 4.5, but there also was like what is it? It was like a 99.8% chance that it would stay the same. So that is as expected. But obviously the press conference a little bit later will matter a lot. So we'll look at that together. That's starting in about 7-8 minutes or something like that. Bodhi, would I open a long position? No, definitely not. It's you're opening a long position into the FOMC. I'm relatively positive about the FOMC, about the press conference, but taking a long position going into that is basically the same as gambling, right? So I wouldn't do that. Let me quickly, and welcome to the stream, everybody, of course, but let me quickly alert everybody that we are live. There we go. And by the way, somebody called me sniffy. Not the case anymore. It's over. It's over for forever. Although I do have a different problem right now, and that is that I have this medication, and I normally already, like I had some sort of allergy or something, or coke addiction, whatever you want to call it, everybody. No, I'm just kidding, of course. But the medication I have, one of the side effects is that your eyes get quite dry, and I already have quite dry eyes. I have these night lenses, right? So these lenses that I wear in the night, and that dries out your eyes quite a bit. So this medication makes them even drier, which is a different problem. But I think that's less of a problem than that sniffy nose and those morning allergies, and those are over right now, which is amazing because look, it might not look like that. But that really fucked up some of my mornings. It's not amazing if your nose is all just fucked up in the morning, and you have to do your analysis, and you have to go through your morning routine, etc. You have to look for trades. So now it's better, but I do have some dry eyes during the a little bit later during the day, but that will be fine. We'll be fine. All right, I sent that I am live everywhere, so we're good to go. Let me go to the chat. Let me see what everyone's saying. Volatility, by the way, quite high, as you can see right here. The fundamentals are decent, I would argue. Decent, I wouldn't call it. Volatility index, oil is up. S&P 500 started relatively strong, but also has pulled back. So relatively mixed day. Obviously, the fundamentals are still going on right now, and everything is quite unclear. But yeah. So welcome to the stream, everybody. Ryan, of course, welcome to the stream. Daniel, welcome to the stream. Glenn, welcome to the stream. Rolf, you called me sniffy. You're not welcome to the stream. Naveed, welcome. Aliasan, welcome to the stream. Pretty baby, welcome to the stream. Yeah, I live in Amsterdam, but yeah, there's plenty of medication here. Trust me. Aliasan, I have a pretty bullish expectation of the FOMC. I mean, most of the economic data that we had over the course of the last month, I would say it's been pretty decent, and the interest rates right now are at 4.5%. It's quite high, right? So I might almost start to agree with Trump in that Jerome Powell is a little bit slow with this. But no, honestly, I mean, I would say that the economic data backs up 0.25, 0.5% rate cuts. But I also do understand the Federal Reserve position that they want to, be a little bit cautious with it. So I honestly see both sides. I mean, obviously, I would prefer some more quantitative or less quantitative tightening, or some quantitative easing, lower rate cuts in general. I would, for me personally, that would be better. But does it really matter? On the long term, I would say no. I think it's a matter of time before the interest rates are cut, and I think good news is coming. But no, I mean, so I'm relatively optimistic about the FOMC as well. Yeah. So Daniel, Relatively good feeling. It's I don't think he's going to say much, but I do think the tone is slowly over the course of June, but also the meeting we have in July. I think it's slowly going to turn into something a little bit more productive for rate cuts. This meeting specifically, do I really expect something? Not sure. Glenn, I hope that Ondo is going to go up because I bought. So it's probably going to go down. Hatim, welcome to the stream. Desmond, welcome. So the medicine I have, it's a very you can just get it at the Kruidvat, of course. But it's called something like Loratadine or something. What is it? Loratadine. Yeah, Loratadine is the name in Dutch, but that's obviously just a normal name. And it works quite well, but it makes you a little bit sleepy, and it takes care of some, or at least it does cause your eyes to be a little bit drier. And there's some other side effects depending on what's going on. Onur, welcome to the stream. Benji, welcome. Ahmad, welcome to the stream. AV Creations, welcome to the stream. Welcome everybody. Welcome here. Evie, welcome to the stream, and also to the Signal group, of course. Crypto Cruise, a shout out from Texas. Well, shout out from Amsterdam back. We almost have to get the stream ready, by the way. But welcome everybody. I mean, I cannot go over everything, of course. Mecca, yeah, I have some recommendations. Avoid the red light district. it's the worst part of the city. Or walk through it once, right? So you can walk through it and go to something like the Nieuwmarkt. That's relatively nice. There's some good places to eat if you find the right places, or to have a beer. That's quite good. Yeah, that's it, Desmond. The major support for Dogecoin, yeah, we can look at that obviously a little. We can look at that a little bit later, but I have to. The stream is almost starting, so we have to get that ready too. Yeah, Ryan, I believe that the red light district is your favorite part. That's within character. No, I'm just kidding. All right, so this is it. Let's see, can we get it live, please? Obviously it hasn't started yet. Let me see, can I get some good subtitles going on right here? Subtitles, options. Make it a little bit bigger. We'll make it background color black. Font size. Font color, can we have that yellow? So we will have captions, and I will put on the on the live stream, right? So we'll watch it together. And what I usually do is that whenever he says something interesting, I'll just say that, and I'll keep my voice live during the stream as well. So if you want my voice to be disabled, let me know. I can do that as well. But for now, I'll keep my voice in, and I'll just tune into the live stream whenever something happens. And it's already going on right now. So let me quickly open this up. The war situation, Navid, I don't know. Honestly, I mean, I think it will de-escalate eventually, but at this point of time, it's still a little bit uncertain. All right,
good afternoon.
Let's get to this.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment,
right? So this is
stable prices for the benefit of the American people. Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has come down a great deal, but has been running somewhat above our 2% longer run objective.
This is just a normal talk.
In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I'll have more to say about monetary policy after briefly reviewing economic developments. Following growth of 2.5% last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were driven by businesses bringing in imports ahead of potential tariffs. This unusual swing has complicated GDP measurement. Private domestic final purchases, or PDFP as we call them, which excludes net exports, inventory investment, and government spending, grew at a solid 2.5% rate. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a decline in sentiment over recent months and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.4% this year and 1.6% next year, somewhat slower than projected in March.
Okay.
In the labor market, conditions have remained solid.
It's not bad.
Payroll job gains averaged
less
135,000 per month over the past 3 months.
To cut the rate.
The unemployment rate at 4.2% remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.5% at the end of this year and next, a bit higher than projected in March.
Also,
inflation
not
has
bad news,
eased
right?
significantly
Because they're
from its
expecting
highs in
unemployment rate to be a little bit higher.
mid-2022,
If unemployment
but
rate is
remains
higher,
somewhat
they're
elevated relative
again
to our
encouraged
2%
to
longer
potentially
run
cut
goal.
some rates earlier.
Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.3% over the 12 months ending in May, and that, excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up over recent months, as reflected in both market and survey-based measures. Respondents to surveys of consumers, businesses, and professional forecasters point to tariffs as the driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 3%, somewhat higher than projected in March.
A little bit
the median
bad.
inflation projection falls to 2.4% in 2026 and 2.1% in 2027.
So,
our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range.
I'll just turn off the audio of Jerome Powell whenever he says something interesting, right? I think that's better.
We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Changes to trade, immigration, fiscal, and regulatory policies continue to evolve, and their effects on the economy remain uncertain. The effects of tariffs will depend, among other things, on their ultimate level. Expectations of that level, and thus of the related economic effects, reached a peak in April and have since declined. Even so, increases in tariffs this year are likely to push up prices and weigh on economic activity. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It's also possible that the inflationary effects could instead be more persistent. Avoiding that outcome will depend on the size.
Slightly bearish, I would say.
Through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we will balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close. For the time being, we are well positioned to wait to learn more about the likely course of the economy before considering any adjustments to our policy stance. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year, the same as projected in March. The median projection.
See, something like this scares me a little bit, right? Because if we're talking about interest rates in 2027 of still above 3%, like, is it likely we're going to get quantitative easing then? I don't know. But all right, that's just some thoughts.
Elevated. And of course, these projections are not a committee plan or decision. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on issues related to assessing the risks and uncertainties that are relevant for monetary policy and the potential implications for policy strategy and communications. Our review includes outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference that we held last month. We are open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up any modifications to our statement on longer-run goals and monetary policy strategy by late summer. After that, we will consider enhancements to our suite of communications tools, including the SEP. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices.
Okay, so far, I have to say, it is a little bit less positive than I expected, right? Because he's still going on about these tariffs and the uncertainty of them, and I expected that with the recent inflation rate data that he would be a little bit milder on that. But those are just my personal opinions, right? I mean, that's based on what I expected from this speech, and I haven't seen that so far. But we're going to get into questions real quick right here, so that might still raise some interesting things.
Thank you. Colby Smith with the New York Times. To what extent has the more limited impact from tariffs at this stage on inflation changed your view on what the ultimate economic fallout will be from these policies and the timing of when they will materialize in the data?
Very interested in this.
So we've had 3 months of favorable inflation readings since the high readings of January and February, and that's, of course, highly welcome news. Part of that just is that services, core services, both housing services and non-housing services, have really been grinding down toward levels that are consistent with 2% inflation. So that's the good news. We've had goods inflation just moving up a bit, and of course we expect, as you point out, we do expect to see more of that over the course of the summer. It takes some time for tariffs to work their way through the chain of distribution to the end consumer. A good example of that would be goods being sold at retailers today may have been imported several months ago before tariffs were imposed. So we're beginning to see some effects, and we do expect to see more of them over coming months. We do also see price increases in some of the relevant categories like personal computers and audiovisual equipment and things like that are attributable to tariff increases. In addition, we look at surveys of businesses, and there are many of those, and you do see a range of things, but many companies do expect to put all or some or all of the effect of tariffs through to the next person in the chain, and ultimately to the consumer. Today, the amount of the amount of the tariff effects, the size of the tariff effects, their duration and the time it will take are all highly uncertain. So that is why we think the appropriate thing to do is to hold where we are as we learn more.
Yeah, okay.
And we think our policy stance is in a good place where we're well positioned to react to incoming development.
So that's just a little bit bearish in my opinion, right? I would have hoped that they changed their stance slightly.
There's this expectation that underlying inflation will just stay well enough contained.
Because we already got the data. That's okay. Or we got some data at least.
In economic activity, let's say. I mean, how should we make sense of the forecast?
So if you look at the forecast, you will see that people do generally expect inflation to move up and then to come back down. But we can't just assume that. Of course, we don't know that. And, our job is to make sure, one of our jobs is to make sure that a one-time increase in inflation doesn't turn into an inflation problem. And that, again, that will depend on the size of the effects, how long it takes for them to come in, and ultimately on keeping inflation expectations anchored.
Hi, and thanks, Chair Powell. Howard Schneider with Reuters. If you look at the rate path starting in December to today and adjust it over the full time horizon you've got there, you've taken about a quarter point per year out of your projected path, and you end at a higher rate at end 2027 than you would have in the prior forecast. Is that a result of a sense that tariffs will lead to more persistent inflation? Is it a result of reassessments of where your short-term neutral rate is? Why are you on a slower path now?
So I would focus most on the nearer term as you get out to the later years. It's hard for anybody to know where the economy is going. You didn't see people moving their longer term, estimate of the neutral rate, for example, at this meeting. So and those things are probably slow moving. So I think if you look at what's happening here since March, this is since March, right? You see a little slower growth, just a tiny tick up, a 1/10 tick up in unemployment, and you see inflation moving up 0.3. And by the way, it was a similar move from the December SEP to the March. So that's what you see. You see the effects of tariffs. I think we learned in April, after the March meeting, that substantially higher tariffs were likely. And then since then, the estimates of where the tariffs will be have actually moved back down, although still at an elevated level. So we're adapting in real time. And what you see is an accumulation of individual assessments.
You say in the statement that risks have diminished on that front, but the July 9th, drop dead date for all the Liberation Day tariffs is still out there and unresolved. You've got now exchange of missiles between two Middle East adversaries with a possible U.S. involvement. How can you justify saying that risks have diminished?
So what we said was that uncertainty uncertainty about the economic outlook has diminished but remains elevated. Many surveys say that. They do. So, and that's actually a line from the Teal book, which you can see in 5 years.
So that's quite positive. A little bit. It's a little bit positive. I'll talk about that a little bit more later.
And since then has come down, and that's really what that's just acknowledging. It's diminished but still elevated. That it's uncertainty. So I think that's an accurate statement.
Thank you. Chris Rugaber at Associated Press. There is an argument out there in favor of cutting rates more immediately. Inflation has continued to cool and is back to roughly 2% despite the tariffs. And I guess I also wanted to ask about cracks in the job market with gross hiring slowing, concentrated in just a few industries. We've seen some housing data, including this morning, that has been pretty weak. Do you see any concerns that the economy is weakening and that is a reason to cut rates going forward?
So we do of course monitor all those things. I think if you look at the overall
It's a good question
picture,
again.
What you're seeing is 4.2% unemployment and an economy that's growing at a rate hard to know given the unusual flows in the first quarter, but it appears to be 1.5%, 2%, maybe a little better than that. Sentiment has come up off of its very low levels. It's still depressed. So you can point to things. The housing market is a longer run problem and also a short run problem. I don't think it's indicative of basically the situation is we have a longer run shortage of housing, and we also have high rates right now. I think the best thing we can do for the housing market is to restore price stability in a sustainable way and create a strong labor market, and that's the best thing we can do for the housing market. You asked about the job market. Again, look at labor force participation, look at wages, look at job creation. They're all at healthy levels.
Yeah, I mean, I'm a little bit afraid this is going to turn out to be nothing again, which we spoke about that briefly at the start, that we weren't sure whether we were really going to get a breakthrough. I hope to get a breakthrough about a little bit more certainty about the tariffs and the effects of the tariffs, and I do think we had that. So let me briefly talk here for a moment. And then we'll get back. But I do think briefly he mentioned that the uncertainty that comes from the tariffs has decreased, but ultimately, even though he acknowledges that that's the case, he also said that it will not affect the monetary policy yet. So it's a little bit double, right? So there's some tones that are slightly positive for us, but there's no action yet, and there's also no idea of action yet that's going to be positive for us.
We had today and yesterday. There are many different scenarios, many combinations of scenarios where inflation does or doesn't prove out to be at the levels we think, and where the labor market does or doesn't soften. And I think what you see people doing is looking ahead at a time of very high uncertainty and writing down what they think the most likely case is. No one holds these rate paths with a great deal of conviction, and everyone would agree that they're all going to be data dependent, and that you can make a case for
relatively positive
for any of the rate paths, I think, that you see in the SEP.
Quick note.
And we do this once a quarter. It's a hard thing to do particularly at this time, but it does reflect. If you see somebody writing down a rate path that involves cuts, that's them saying, yes, I think we will get to a place, more likely than not, where cuts will be appropriate, and it could be a joint probability of a number of possible outcomes. Again, remember how much uncertainty we face, though.
Thank you. Mr. Chair, I wonder if you could describe for us some of those scenarios. How do you get to a place? I'm noticing that the uncertainty levels in your forecast are very high. How do you get to a place where you have the confidence in the outlook for, say, inflation and or growth or the unemployment rate? How many months does it take, and what do you want to see in the data to get to that level of confidence to actually reduce rates off the restrictive level?
So it's very, very hard to say when that will happen. We know that the time will come. It could come quickly. It could not come quickly. As long as the economy is solid, though, as long as we're seeing the kind of labor market that we have and reasonably decent growth and inflation moving down, we feel like the right thing to do is to be where we are, where our policy stance is, and just learn more. And in particular, we feel like we're going to learn a great deal more over the summer on tariffs. We hadn't expected them to show up much by now, and they haven't. And we will see to the extent to which they do over coming months. And I think that's going to inform our thinking,
positive, maybe,
for one thing. In addition, we'll see how the labor market progresses.
He's not giving us much.
At some point, it will become clear. I can't tell you exactly when that will be. And meanwhile, we'll be watching the labor market very carefully for signs of weakness and strength.
So far,
and tariffs for signs of what's going to happen there. And of course, there are many developments ahead. Even in the near term, developments are expected on tariffs. So I think we don't yet know with any confidence where they will settle out. We have an estimate, and it's I think all estimates are now pretty close together, but it's again highly uncertain.
When you say estimate of the impact of tariffs on the core PCE, is that what it is? And could you share that?
What you start with is what's the effective tariff rate overall, and people
Bitcoin
are
is also
managing
doing
to
nothing,
that.
by the way.
But the pass-through of tariffs to consumer price inflation is a whole process that's very uncertain. As you know, there are many parties in that chain. There's the manufacturer, the exporter, the importer, the retailer, and the consumer. And each one of those is going to be trying not to be the one to pay for the tariff. But together, they will all pay for it together, or maybe one party will pay it all. But that process is very hard to predict. And we haven't been through a situation like this. And I think we have to be humble about our ability to forecast it. So that's why we need to see some actual data to make better decisions. We'd like to get some more data. And again, in the meantime, we can do that because the economy remains in solid condition.
Nick.
All right, last question, I think. The questions are getting a little bit repetitive now.
Chair Powell, I guess I'm wondering if you could explain a little bit more the divergence we see in the dot plot, particularly around the 2025 rate projections. I realize this is, you have one group of officials that are putting down no cuts, another that are putting down
somebody confirm
more than one. And again, recognizing that could be difficult to summarize, but is it a matter of people having a different outlook, or a different reaction function, a different commitment to defending against another inflation mistake? How did that play out over the last 2 days?
So you're right. This is often the case. We have a pretty healthy diversity of views on the committee. We did have strong support for today's decision and broad agreement that our policy stance does leave us in a good place. But I would point to two factors, and you mentioned them. The first is just that parties have a diversity of forecasts, and they do align with where their dots are. So if you have a higher inflation forecast, you're going to be less likely to be writing down more cuts. But remember, as we see more data, we're going to learn more about where inflation is headed, and that means when it is time to look at normal,
All right, that's enough. It's enough. We're not going to get anything from that, I think. All right, so let's do a little bit of a recap here together while I move my webcam to the right place again, right there. This should be right. Yeah, that's better. Listen, it's it was a little bit disappointing, I think. I expected, or at least I hoped, that we would get a little bit more certainty, or at least that the economic data that we had over the course of the last, the last month or so, that provided a little bit more certainty for the Federal Reserve to say, all right, well, these tariffs are going to cause a little bit of inflation, but it's a little bit less than we expected, so we can talk about rate cuts. And what they're saying, as most of you know, is basically exactly the same thing as what they said the last time back in May. And that is that they're still uncertain about these tariffs. And they think that the effects are going to be measured, or potentially will be measured, because who knows? I mean, maybe we will not see it. But that they will potentially be measured later and during the summer. So that means that we're most likely not going to get rate cuts in July either, which was already to be expected. That's not bearish for the markets or something, but not for July. And I would argue that the possibilities here. Look, I mean, for July, it's already 87.5% sure that we're not going to get a rate cut. And for September, it's actually quite likely we are going to get a rate cut, but that's September, right? I mean, that's the 17th of September. That's 3 months from now, which is a very long time in the future. But no, I mean, therefore it's a little bit more bearish than I expected. This is the 15-minute time frame for Bitcoin. I would say it's still relatively stable. There's a bit of a pullback right now. Obviously, the fundamentals are also not great right now in the markets. I mean, you can see the S&P 500 right now pushing down. So that almost makes me think that we actually had some sort of news coming out of the Middle East, which is not true. I mean, it's quite stable. Gold is falling down right here. Volatility index is high, but it's also stable. And oil has also been stable over the course of today. So no, unfortunately, I think this FOMC, this Federal Reserve interest rate meeting, was a little bit of a nothing burger, which I hate, right? Because all of you tune into these streams as well to get some news, to get some action. But that is what we have to say. I mean, there were some parts in the press conference which I thought were relatively positive, right? That at some point of time he said that some of the uncertainty had been taken away. And also that the path that the different Federal Reserve meeting members expected for the interest rates over the next 3 years was also not with a lot of confidence, right? So that means that it's still very fluid in terms of if we get new economic data, if we get some updates, or if we get some developments. It could still be that we get, 3 rate cuts is going to be very difficult this year, but at least like 2 this year, maybe more next year. So there were some positive things in that, but the general sentiment and the general idea that I think Jerome Powell spoke about in the press conference is the same thing as what he said last time. So that's relatively bearish. Now, if we're taking a look at Bitcoin here, we're within this balance right here, between 106,800 and the value area low right here at 103.6. I would say, especially also taking into account the fundamentals, I would say it's a little bit more likely we'll pull back. Look, ultimately, now we're just going back to the other fundamentals, right? So now we're going back to Israel and Iran, and what's happening there. Do we see an escalation there? Do we see a de-escalation? Which I'm already getting a little bit tired of that, even though it hasn't been a week. But we're probably going back to that. And I think if you zoom out for Bitcoin right here, I think we will remain stable. I think Bitcoin will ultimately remain stable in this area right here, between 100,000 and 108,000. I think that is to be expected. But short term, that does mean that we can have a lot of volatility, and that also means that we can still pull back a couple of percentages lower. And who knows what that's going to do to altcoins, right? I mean, you can see altcoins right now pulling back quite aggressively, even though the Bitcoin dominance over the last hour has come down a bit, I think. Well, a little bit over the last couple of hours. So yeah, those are my expectations. I think that's what you need to know regarding the markets for now, which is unfortunate. I mean, maybe like I said, I mean, we could definitely still see a turnaround, but it's unlikely that it comes from this FOMC. We saw some de-risking before this FOMC, so stability, I do think, is a possibility, and I do think that that's almost most likely potentially. But it's going to depend a lot on other fundamentals right now. So that's it. All right, let me go over some messages right here. Good morning, Fufu. It's not morning anymore where I'm at. Sippy, listen. If they give me the call tomorrow, I'll replace Jerome Powell and I'll increase the interest rates to 6%, destroy the U.S. economy, and then lower them a lot. Quantitative easing. Buy the dip on Bitcoin when I've hired it to 6%, and then up only. Flip one over. I'm not certain if we need rate cuts, but they would help, right? It's in general for the short term. Does it really matter? No, but for the long term, it really does, right? And also for our stock portfolios, etc. So yeah. Yeah, it's it's pretty boring right now. Bitcoin, Ryan, check the spot signals. I have some limits lower for Bitcoin. But that's it, guys. That's everything I think you need to know. I don't think we got anything new. We're getting a bit of a pullback right here because I think a lot of people are thinking the same as what I did, right? So I think a lot of people expected a little bit more positivity, and we did not get that. Now, ultimately, does that mean that we're going to crash right now? I don't think so. But now right now we are in the hands of the fundamentals again, and we are very dependent on what's coming out of that. Volume, by the way, quite low. So that's interesting. There's not a lot of volume selling Bitcoin right now. I mean, if you compare this bearish momentum to the bearish momentum we had the Thursday the 5th of June, but also last week Thursday the 12th, volume was about 2-3 times higher. So that's another confirmation for me that we are going to hold the bottoms. But you know, the strong bottoms at 102.5. And then 101.5, and then under 100,000, they're still lower, right? So short term, I would expect lower, but ultimately I do think we'll hold support, and I think we'll gain stability from there. So yeah, that's it for now, I think. Do you think Bitcoin and altcoins can rally without a rate cut? Yeah, I think we can. I think altcoins and Bitcoin can rally without a rate cut. That's also what we did ultimately in 2024. Right, so at the beginning of 2024, but also at the end of 2024. So that's definitely a possibility. But like I said, it helps, right? That's the only thing. The bottom for Athena, Bus, I'm not certain. Right now it's at a major support level, which I expect to hold. I personally hold some Athena spot. If the current support level doesn't hold, I'll probably sell. Because then the possibility and the risk of going into a new downtrend is just too high. So right now at a crucial level, which I'd watch, and otherwise we're probably going into 20 cents or something, I'd say. But yeah, that's it, guys. That's a live stream for now. We covered the entire press conference, or at least most of it, until we've heard enough. Going to end the stream right now. Going to still do some analysis. Like I said, short term, I think we can push down a little bit lower. But ultimately, I do think, I don't even expect, unless we get escalation fundamentally, I don't expect us to drop down this low. I think this level, actually, where we're at right now and a little bit lower, is going to hold. And then I expect some stability right here. Those are my final thoughts. Thank you all for being here. I sincerely enjoy these live streams a lot always. So again, thank you for being here. I'll see you all in my next videos, hopefully tomorrow morning. But for now, have a great evening, have a great day. Take care.